Thank you so much, Enrico and Alu, for that firstly very kind invitation and then an even kinder introduction. So what we decided is that rather than showing you graphs and, etc., I just thought I'll speak very openly about my experience as a central banker. I think it's more fun. I think maybe it's of no use, but it'll make for a good lunch conversation. And, just on a light note, like my reputation with the Indian government is that now I'm an academic who just talks and doesn't do any research. So today I will stick to my reputation. I will just talk and not do any interesting research. It'll become very clear after my talk why I have that reputation and why they have an interest to perpetrate that reputation about me. I should also mention on a light note that the book did so well that my publisher has actually gone bankrupt. Sage India is now bankrupt, and I'm looking for a new publisher for my book.
You were the last straw.
Yeah, if you have any other publisher that's anyway going bankrupt, just let me know, and I'll just join forces with them, and we might make a good team. Unlike the kind of relationship I had with the Indian government. I want to talk a little bit about fiscal dominance. Of course, it's a very old and beaten theme. Is there anything new I have to add? I'm not sure. Sometimes I feel I have something very deep to say about it, and sometimes I feel it's so obvious that I kind of feel I should not say anything about it. But maybe as just a very plain description of my term at the central bank, and I was there from January 17 till July 2019. I'll give you what the backdrop was and why it was such an exciting time actually to go to the central bank at that time, and I think it still is. I essentially the main message I want to convey is that I think fiscal dominance should be a much bigger theme in my view that goes far beyond the monetary policy. I think my sense is it affects everything that a central bank does, including regulation of banks. In fact, in my view, that might be a bigger impact going forward than just monetary policy and inflation. But as you will see, when you have an all-purpose, so the Reserve Bank of India is an all-purpose central bank. It does everything. It does supervision of banks and non-banks, regulation of banks and non-banks. It's in charge of the Deposit Insurance Authority. It's in charge of external sector operations, so foreign exchange, reserves management and interventions. Of course, it does liquidity operations and sets the interest rate and tries to ensure that money market rates are in line with the policy rates. And you will see that it's in charge of many government mandated things like where should banks lend, what are the norms for that, to enforcing those norms and so on. So it's an all-purpose central bank. And of course, you can see then that it's maybe maybe Reserve Bank of India has always been what I think the rest of the central banks are trying to become, which is they want to do everything under the sun. They think it's like that's the call of duty right now. I think they may be right. But I think if the mandate of the central bank expands into bigger territory, I think fiscal dominance will likely become relevant in each of these territories, in my view. I have a very simple view of political economy. It's something that one of my school teachers in India taught me in my mother tongue. Of course, I didn't know anything about economics that time, but just 6 words, and I find it's probably one of the deepest things I've heard on political economy. It's actually, it's sort of like a proverb or something that's colloquially passed down through generations. It's probably at least maybe 1,000 years old, if not 2,000 years old, this saying. It basically says in my mother tongue that where the king is a trader, subjects are beggars. And, of course, it's you can see where I'm going with this. I found it a very fascinating description of India over time because India is very stuck in centralized control and allocations. It's achieved through a variety of ways. It's achieved through state-owned banks, state-owned enterprises, and then you have to sort of modulate the regulation of these enterprises and banks to be different from the privately owned banks and enterprises. And to be able to do that, you have to have laws that enshrine them differently than private sector enterprises and banks. And you need the help of the central bank to achieve this sort of separation between how state-owned banks and enterprises are dealt with versus how private enterprises are dealt with. And it's my concern at a very broad level, this is just my chit-chatting as I told you, that my sense is that the political and growth challenges of advanced economies are increasingly resembling those of emerging markets, in my view. And what do I mean by that? I've seen India go through its leverage boom and bust cycles, and you are sort of at the beginning of the leverage boom cycle. The country is sort of growth hungry. You really want to grow fast, and you want to push leverage. Sometimes, or often, or inevitably, you get some shocks, and it doesn't play out. Then you get growth anxious, which is, you now sort of feel that growth, you can't keep up with the growth that was generated in the last few years through the support of leverage. And how do you keep it going for a little longer? And then you push on leverage a little further through whichever mechanisms you can. And then it fails even further, or maybe you even get a crisis. And then you become sort of very growth desperate. So you go from being hungry to anxious to desperate. Maybe that's also the way a lot of people approach their nutrition and food. But I think economies seem to also do this, in my view. And I'm seeing this sort of increasing desperation for growth in advanced economies. And with that, I think we are also seeing a lot of shift in advanced economies towards centralized control. I actually think there is a shift in the ideology among the economists of the advanced economies, so the ones where I sit and where I'm surrounded by. I think more and more of this centralized control seems okay. Every other paper that I see that comes out mainly talks about why government intervention in a particular setting would make sense, why it would be justified in that case. And most of the times it's without actually thinking about unintended consequences or looking at long stretches of history where such interventions have been employed, and then what have been their longer term consequences for these economies and the interventions. But that may be perhaps why my experience may be relevant. But of course, right now, no one is interested too much in it because a lot of economists want to justify what is happening rather than what might happen going forward. So let me give you the backdrop of what happened when I was going to India. So I think to get a full picture, you have to start with the global financial crisis. The global financial crisis for India was not terrible, in the sense that India was not directly exposed to the US or the Western housing markets. India did have a retail housing boom in the lead up to 2008-09 crisis, but a very prescient central banker, Dr. Y.V. Reddy, who was the governor of the Reserve Bank of India prior to that, he had implemented what I think may have been world's largest and most successful macroprudential housing policy. In 2006 and beginning of 2007, India actually raised loan-to-value ratio and debt-to-income ratios. The markets. So India had actually started correcting the housing price market by central bank intervention in 2006. And therefore, 1 year of buildup that could have gone on even further didn't happen. And so India had a relatively soft landing as far as the housing market was concerned. There were some private banks in India that were still exposed to some international operations. They were still exposed to some poor quality of loans in the housing markets. And there was a run on these banks, but it was sort of brought under control relatively quickly after the collapse of Lehman Brothers. The real problem was, giving this analogy that I mentioned of being sort of growth hungry to growth anxious to growth desperate, was that the government at that time, which had just come back to power, wanted to continue to show that India could grow at 8%, 9%, 10% per annum. Getting to China's levels of growth was considered as like a very important sort of messaging to the population in order to ensure that you remained attractive on the vote bank. So, and I think this is very interesting, because by no stretch of imagination was India not doing well at that time. India was actually registering 6, 7, 8% per annum growth. But what was crucial was to keep up that level of growth and continue to deliver on that level of growth. Now, of course, with the collapse of world trade that was feared around the collapse of Lehman Brothers, all of this became a little bit uncertain. Could India keep delivering this growth without foreign money coming in, without export of services that were now at the risk of being demanded by the rest of the world? And so what happened that time was quite remarkable. It was actually a full-fledged use of the Indian public sector banking apparatus to do a very large fiscal stimulus in the country. So essentially, both China and India, in my view, undertook very massive fiscal expansions after the global financial crisis in order to ensure that their growth levels remained at 7, 8, 9, 10% per annum. It's not as celebrated, but in my view, this was actually the true stimulus for the rest of the world at that point of time, because no Western economy actually grew much in 2008, 9, 10. It took a while for all the policies to come in place. Now, how did this stimulus work? I'm not exaggerating. The finance minister used to pick up the phone and call the public sector banker and say, this particular company needs X thousand billion rupees. 5 of you have to go and approve this loan. Okay, this is exactly, it used to be called phone banking in India, which is that the finance minister would pick up the phone and tell the public sector banks where they were supposed to allocate their credit. And these were just targets. Why is it important for public sector banker to honor these requests? Because their promotions get decided by the finance ministry. So of course, if you're going to say no to the finance minister, you will be managing perhaps the smallest public sector bank in the next round of rotation of these CEOs and managers, etc. So as you can believe, credit got allocated left, right, and center to whoever was wanting to set up any enterprise in India that had some brick and mortars that could be pledged as collateral. To just give you a sense of how large this stimulus was, India produced capacity in its thermal power sector, which was 2.5 times the requirement of its consumption needs at that point of time. Okay, so of course, India is growing very fast. It has a population that's also growing very fast. So at some point in future, a 2.5x will still be consumed, but you can see this has now tremendous risks. If you create so much excess capacity and it can't sell what it's generating for several years of time, there's going to be loan defaults along the way because there's no cash flow coming in for a long period of time. So by 2011 and 12, it became very clear that this fiscal stimulus had gone awry, that there were just a lot of bad loans, especially on the public sector bank balance sheets at that point of time. Now, what is the problem? The problem is that India didn't have a well-functioning bankruptcy system to resolve these assets. Okay, so usually it can still work if you can do private negotiations between bank debt and the borrowers, and you can rewrite the contracts, you can extend maturity, etc. But these were public sector banks, and of course, this problem did not stay just with public sector banks, but because these were public sector banks, if they took losses on their balance sheet against these bad loans that were made, they would have had to be recapitalized by the public exchequer. So finance ministry would have to allocate a set of funds in order to recapitalize these banks so that they could meet, the Basel capital standards, et cetera, and be allowed to function. So on the face of it, of course, India subjects its banking sector to Basel standards, but there's tremendous national discretion, as we know, in how the loans are actually marked at the end of the day, So the central bank engaged in what I would say at least 2 or 3 years of very, very substantial forbearance. Okay, these were explicit schemes under which banks were told you can recognize your bad loans as standard assets, even though there was no hope of any recovery, or at least not a full recovery on these loans. I don't have much sympathy for what happened because I believe that marking a bank balance sheet correctly is probably the most important function of the banking regulator, in my view, so that these things don't become zombie lending institutions. And, that's the history of Japan and several other countries thereafter. But the explanation given by the central bank was that we had to do this because these banks are owned by the government, and the government did not want to chip in the money in order to recapitalize these banks. Now, note that in some sense, India doesn't have a fiscal problem to recapitalize these banks. What is the problem? The problem is that if you set aside money to recapitalize these banks in your annual budget, you have to cut back somewhere else, or you have to justify to the parliament or the population why are the fiscal deficits of the country rising beyond a certain size. So, India has huge fiscal deficits because India does a very large amount of welfareism. It's a poor country. Welfareism is popular. Maybe it's even justified. But the moment the recapitalization bill of these public sector enterprises comes to the finance ministry, in that particular year, the fiscal deficit either has to expand or they have to cut back on other revenue expenditures because they might be subject to certain fiscal targets that the parliament wants them to meet. And I'll come back to that. In any case, so this became like a perpetuation of these bad loans. Not only were loans not recognized, most of the times they were not recognized by further extension of credit, just like the Japanese evergreening of these loans. And so not only did the bad loan problem not remain contained, it actually blew out of proportion. It became really, really large. At its peak, my sense is the public sector banks in India probably had not stated more than 10% of their balance sheet in bad loans that they should have actually recognized. So, the undercapitalization problem was very, very substantial. So when I left for India, that was the backdrop. So, given my research and given my experience, so I was sitting at Newark Airport, taking my flight to go to India. I said, maybe I should have a plan of what I'm going to do as a deputy governor. And I remember I just wrote 2 sentences on my to-do file. The first sentence was fix the Indian public sector banks. That was bullet 1. This is literally copied from that file. And the second sentence was unleash the power of capital markets for efficient allocation in the Indian economy. So what was that I wanted to do on India's public sector banks? I thought, just to give a little bit of historical context, India's banks were not always owned by the government. They were actually mostly private. But in 1970, the government of late Indira Gandhi, as the prime minister, they nationalized Indian banks in 2 big acts, two big legislative acts. These were forced nationalizations. Why were they nationalized? And that reveals a lot about how these banks have been used historically. They were nationalized because Indira Gandhi's government was becoming weak. As a central government. She was losing popularity, and she wanted foot soldiers in every village of India to basically deliver her national programs. And there was no other way to do this other than to take control of banks in India. So they wanted full central control over every individual bank branch so that you could send an order to the bank branch saying, deliver so much credit to such and such sector in farming, in small, micro, medium-sized enterprises, etc. And these branch managers, these loan officers basically became foot soldiers of the government in order to deliver the central government's program so that you could show that economic activity could be supported, things were happening. And effectively, what we call in India is that you buy votes with banking credit, or what I think Raghurajan called in his book as let them eat credit, Maybe they don't have other things, let them eat credit. So I think my sentence, his title in Fault Lines really originates from how India was actually using its banks. So I think it seems most people seem to agree that it's very important to privatize these banks. To do that, you'll have to, of course, first recapitalize them because no one's going to buy them when they are completely shorn of any capital and they're entirely insolvent. And I thought that what India really needed and it lacked was that there was no prompt corrective action in place for Indian banks, which is that they can bleed, they can go to whatever levels of capital, and you don't stem the losses before actually they are completely wiped out. And while it is not perfect, my experience was that at least for smaller banks, this seemed to have worked quite well in the United States. And perhaps the problem was that the larger banks, through their organizational structures in the US, had found ways to not be subject to the prompt corrective action of the FDIC. But of course, to do that, you have to first recognize the losses. And so that was sort of like the first component of it. On the second agenda, the Reserve Bank of India is often, because it's an all-purpose regulator, historically it has been seen as being too intrusive in foreign exchange and government bond markets. To just give you a perspective, India never had a foreign exchange market when there was the foreign exchange crisis in 1991. Central bank governor at around 2:30 or 3 p.m. used to announce what is the exchange rate. And basically everyone had to, exporters, importers had to basically trade at that price in the market. And then, over time, of course, many governors realized this is crazy and, they developed the market. Why has Reserve Bank of India historically not been keen to develop government bond markets? Because it is charged with placing the government debt. It is the debt auctioneer of the government of India. It's sort of a very conflicting set of objectives, as will become clear. But then the government mandates to them through back channels that don't allow the yield to exceed a certain rate on this auction. And then, of course, if it's a very well-functioning market, prices will reveal that, and therefore they don't actually want a fully revealing price-setting mechanism in the market. So this has huge distortions, as you can imagine. So at least some of us who had been studying the Indian markets and economy for a while, we thought that maybe at a minimum, whatever regulations are in place, they should become principle-based so that the central bank is not intervening auction by auction in the price setting of where the market clears and so on. So anyway, those were the two sort of to-do items. I thought it was, at some level, a relatively modest agenda. I am very practical about what my chances would have been. I knew there would be tremendous resistance from governments and the cronies of the government who would not want any of these things to get to be reformed. But of course, just because you are pessimistic doesn't mean that when reality hits you, you don't feel bad about it. Okay, so I think it's still too early to tell what the outcomes of trying to achieve that agenda were. But I think in hindsight, I think 3 years back, I thought that we probably had very limited success in the first agenda of fixing public sector banks. With a little bit of time having gone by, I'm now actually convinced that that agenda has been perhaps remarkably successful, actually. And the reason is because we did manage to implement prompt corrective action. We did get the government. What happened is it was a very sort of almost a bit of a rebellious central banking trick, which is we said, if we can impose prompt corrective action, we can tell the government, if you don't want to recapitalize the banks, fine, but then they can't lend, because we can't allow undercapitalized banks to be lending in the economy. And one thing you notice with the political system is that they all want to say that they are for structural reforms. Okay, so if they can get a newspaper article tomorrow morning saying they have supported a key structural reform in the country, they love it, because it like strikes a chord with a big part of the population. So my sense is in that little bit of greed for nice media coverage, the government of India keeps signing on to a lot of structural reforms that in 6 months' time, they've realized that, oh, this is way beyond what I had imagined this would be, or that I've ceded a lot of control to the central bank, or I've ceded a lot of control apparently when India's inflation target, just to make it very precise, when India's inflation targeting act was signed, I'm told by the then governors that they actually told the finance ministry that I hope you realize what you are signing. You are giving control to the central bank legislatively to set interest rates only to primarily control inflation. And that this is a big step, I hope you realize what you are doing. And they said, no, we have to adopt these international practices, this is the way to go. This is the way we'll build confidence in the markets. And they signed it. And of course, 2 years down the line, when interest rates had to be raised for the first time, they were so grumpy with the central bank that, why are you doing this? Can't you see, we have to prime the economy up before a state election or a national election or whatever. So my sense is once again, the prompt corrective action, of course, didn't have to be signed in law because the Reserve Bank of India had all the legislative powers to design prompt corrective action the way it wanted. So under pressure of these banks not lending, the public sector banks even got recapitalized far more than they had been historically. There was an asset quality review that Governor Rajan had put in place, and then it continued under Governor Patel's term. I joined Governor Patel when I was the deputy governor. So losses started getting recognized. And the key point, which I think was very crucial, and now actually a series of academic papers are coming out on it, I'm very delighted to see that, is that in 2016, because India didn't have a bankruptcy code, the current government, which is in power, which was also in power at that point of time, they actually put in place a new bankruptcy code. And this bankruptcy code was to resolve non-performing assets with a very strict timeline, okay, that within 270 days, the resolution procedure had to achieve a sale of this non-performing asset firm. Now, of course, just because you have a bankruptcy system in place doesn't mean banks will take the cases to the bankruptcy. Okay, so that was a real problem in India, which is that because banks did not want to recognize losses, they were simply unwilling, even when the bankruptcy system was put in place, to file any of these cases to bankruptcy. So the Reserve Bank of India, under its legislative powers, actually directed the banks to file by proportionality the largest non-performing assets into bankruptcy. This was actually required by the central bank under the powers that it thought it had at that point of time. Then the process got started. And the reason why this has worked well, I'll come back a little bit more to it, but the reason why it has worked is that because this system now started working, banks actually, once the resolutions happened, banks realized that, oh, we can actually get some money out of these bad loans, sometimes 40 cents on a dollar, sometimes 80 cents on a dollar, depending on the size of the loan. And actually, assets changed hands. Bankrupt companies, which had been sitting in hands of promoters who had run them aground for like 7-8 years, they actually lost ownership and control of large assets. These changed hands over to other healthier firms in the economy. And this has had a huge deterrence effect on existing companies which are not yet bankrupt. They simply don't want anymore to take on massive quantities of leverage. They don't want to lose control. And so they try to fix their balance sheets before things get really out of whack, because now there's a real deterrence threat that the company may actually be put into bankruptcy by the bank. So the reason, in my view, why India is able to grow so well in the last year is because actually it has a very under-leveraged private system. Banking system is not very leveraged now. The financial sector is not leveraged now. And actually corporates are not leveraged now. So actually they are able to benefit from whatever growth impulses there are in the post-pandemic economy without having to worry about this sort of overhang of bad loans. When I finished the term, I thought we had achieved far more success in capital markets, in developing derivatives markets and so on. But in hindsight, I think maybe the success has been more moderate, but it remains to be seen. One big thing that we tried to do was to actually create benchmarks for lending in the Indian economy, which is that when the central bank changes interest rates, Can we have floating interest rate benchmarks so that if loans are indexed to those rates, then there is an immediate pass-through of monetary policy to the real economy? This was something we put in, we created the benchmarks, we required indexation of the loans to these benchmarks. And we actually see now that when the central bank raises or lowers rates, the pass-through is actually more a matter of 1 or 2 quarters rather than 4 to 6 quarters in terms of bringing inflation under control. Okay, so that's sort of a broad sense. However, throughout the term and maybe even at the end of my term, the sense I had was that whenever we tried to move one step forward, there was an immediate set of forces in the economy that were wanting to push the reforms 2 steps back. So, for example, we started requiring that banks file these cases to non-performing assets. And then I mentioned the power sector for a reason, because that was the sector that ultimately, in spite of the huge excess capacity, started lobbying the government, saying this is a very critical sector for the economy. How can these assets be liquidated? There are some very big, large corporate honchos who are sort of close to the government or at least very influential in the economy. So, they lobbied the power ministry. And in my view, whichever way, whether it was these pressures or otherwise, ultimately the right of the central bank to ask banks to take these cases to bankruptcy was struck down by the judiciary, sort of about, I would say, 12 months after these actions were undertaken. Some slightly narrower powers are still in place in order to achieve something similar. But you can see that the immediate impact that we desired to have on some of the larger assets was stopped. Similarly, some of the reforms to develop the derivative markets in foreign exchange and treasuries, they're always under a lot of resistance. And the resistance can come directly from the government. It can come through the appointees on the board of the central bank from the government. And I realized that for each particular case, you could come up with a very specific reason why the government wanted what it wanted to do. But in the end, I realized that it all came down to government's ability to spend money in order to pump prime the economy at the time of state and national elections. That was the long and short of it. Structural reforms, when they are surely in power, are a perfect thing to undertake, but they want everything to be also reformed backwards in a state contingent and dynamic manner, so that if the structural reforms become a binding constraint for achieving success at a state or national election, then you want basically the right level of flexibility, as they call it in India. And there's a term in India called thoda adjust kar lo, means please adjust things a little bit. Like what it means is that you kind of bend around the rules on a very sort of nimble manner, so that you're basically a very pliant regulator or a central bank. Now, why am I just mentioning this fiscal dominance theme? Because the way it's defined, I won't go through the definition. You all know it. I think it's fair to say that even the modern treatment of fiscal dominance that we see is mostly focused on monetary policy. It's focused on inflation targeting goals. It's focused on its trade-off between growth and employment. And then we have this nice Kidland-Prescott rules versus discretion framework to think through it. There's the Sargent-Wallace arithmetic to take care of that. And, Guillaume Plantin and other co-authors at Banque de France have now like a nice setup to think about the role of liquidity management in the midst of the Sargent-Wallace arithmetic and so on. But primarily, I would say it's focused on monetary policy. And what I realized is that if central banks world over are going to do more and more and more, actually fiscal dominance may no longer remain specific to just monetary policy, but go far beyond monetary policy. So I think my sense is that it's especially likely to get into bank regulation, but I'll give you subtle instances through which it can become all pervasive, and that was my experience at the central bank. How am I doing on time? 10 more minutes?
5 more minutes, maybe 10.
Okay, 5 to 10 minutes. Okay, so let me quickly describe a few of maybe what may seem obvious, but maybe some might be a bit surprising. So, of course, on bank lending, once you have state-owned enterprises, but I think even when private banks are in trouble, we have seen the world over that governments are very reluctant to resolve the large banks. They are too big to fail, too systemic to fail, too many to fail. We have a number of terms to not break up their large size and so on. I think it's true in most countries. For all the negative coverage that the collapse of Lehman Brothers gets, my sense is that was the only way the banking reforms could have been brought in place in the United States. I think you needed a spectacular bank failure. And in my view, if Europe had a spectacular bank failure in France or Germany, I think European banking reforms would have happened far earlier than they happened. I think governments don't want to recapitalize banks, and then they are constantly looking for ways to engage in excessive forbearance. It happens through loan loss recognition, zombie lending, protracted provisioning, soft capital requirements by exercising national discretion on top of Basel standards. Liquidity coverage ratios are very welcome in some countries because this is a way to get banks to buy government bonds and keep, cheapening the cost of government borrowing in the process. One very fascinating form of fiscal dominance I observed was the following. When I was a deputy governor, I just started out. I wanted to understand the scale of the non-performing assets problem. So I went to the deputy governor in charge of supervision and said, can I get a sense of which banks have exposure to which firms? And I was told that, sorry, that's privileged supervisory information. We can't share it across different parts of the top management. So I said, okay, this is not a big deal. I'll be able to find out, which firms have actually defaulted on their loans. That should be public information because they've defaulted on bank loan. That's materially relevant information. And then I found out that on the Indian stock exchange, if a publicly listed company at that time defaulted on a bank loan, it's not required to be disclosed to your shareholders. This seems like a basic violation of not disclosing materially relevant information to your minority shareholders. And then, there was a governance committee in place at that time. So I fed them this knowledge of this fact. And they said, yes, we should fix this. We should really require this. And it turned out that the government had a huge resistance to this simple change. And it's because for two reasons. One, if public sector banks, if their non-performing assets and their underlying firms were revealed to rating agencies as having defaulted on loans, they would get downgraded. If they got downgraded, the capital requirements on these loans would rise, and that would raise the finance ministry's bill to recapitalize the public sector banks. Second, India has public sector enterprises, which are also often in default. So if their defaults are public knowledge, then they will get downgraded, and then their cost of financing might rise. Banks will be reluctant to provide funding to them at the same costs because they would be at a higher capital requirement under the Basel norms. And so you could see that the government wanting to save its fiscal deficits primarily for revenue expenditures in a very subtle way was actually affecting what are the disclosure standards on the Indian stock exchange. And I thought this was like a fascinating fiscal dominance of disclosure standards of companies to public shareholders. And, of course, I can go through a few more of this. One of the most common forbearances in India, which I think perhaps could become a norm in other parts of the world if interest rates keep rising very sharply, is that whenever interest rates are raised, banks are allowed not to mark-to-market their treasury bond positions. Because if they mark-to-market their treasury bond positions, they become less willing to take more of these bonds in the next auction. the cost of government borrowing rises as a result of this marking to market. And then rather than accepting that and adjusting your fiscal arithmetic to deal with it, of course, the governments want the central banks to not actually want mark to market. One reason why the liquidity coverage ratio is helping out the modern banking system on this front is because assets which are called high quality liquid assets under the liquidity coverage ratio, as far as I understand, are not required to be mark to market. They can be in available the buy to hold asset class, which in my view makes no sense, because the whole idea of liquidity is that you should be able to sell it when the real bad situation comes. But what you will get when you sell it is the market value of these assets and not the price at which you purchase these assets. But, there are these kinds of weird things. And I think some of these probably have to do with having some transmission then to the cost of government borrowing. I think let me come to maybe a couple of other points, which is that
maybe also.
Maybe. Okay, so maybe I can talk a little bit more about some other forms later on if there is time. So does all of this matter? I think my sense is it does. Central banks and central bankers who are sticking to their mandates, like what got called as sort of hawkish governors or boards at certain points of time. They are quite unpopular in the short run. They are unpopular with the governments. They are unpopular with corporates and large, powerful incumbents. They can be unpopular with markets because short-term growth can sometimes be a cost as well. And so if you have the good fortune of not being hit by a crisis when such governors are in place, then you can get rid of these governors quite easily because there is public support to actually get rid of them. Corporates are happy, markets are happy if you get rid of hawkish governors and bring in dovish governors. And I think it happens quite a bit. In India's case, actually, we did have an external sector crisis. I think what happened in April to October 2018 looked pretty much like a little bit of a taper tantrum and the current emerging market scenario playing out on a smaller scale because oil prices rose again from $40 to $80 per barrel. I thought a lot of the reforms that we put in place had stood the government quite well during that time. But there was a national election coming up in 6 months. They wanted to allocate more credit at the last mile. And ultimately, there was a change of governor at that point. And I think that was all sort of this fiscal dominance not being allowed to play out on the bank lending allocations in order to influence the political outcomes in the end. I think let me stop here. I'll just mention that when the pandemic happened, I was quite stunned by the scale of fiscal and monetary stimuli that developed economies adopted. I fully understand the humanitarian aspects of the crisis, but I think a lot of these stimuli continued way beyond normalization of the pandemic and the growth coming back. If you look at the US stimulus in particular, I think there was no need for quantitative easing of mortgage-backed securities past December 2020. These markets were functioning perfectly well. There was no sign of any disruption in this market that you were trying to fix at all. But I think perhaps the focus got shifted entirely towards full employment. I was worried about zombie lending as well. At least to date, it hasn't yet surfaced as a big issue. We have to wait and see if interest rates have to rise significantly higher, whether it comes back to haunt or not. But I see very clear trends that what we were dealing with in India in terms of like a full frontal fiscal dominance of the central bank on sort of every single operation that the central bank was doing. I think central banks in developed economies are slipping down that path, in my view. I think if they go down wanting to do climate change, etc., without having a clear legal mandate to do so and clarity on how to do it, I think they could get caught up in all kinds of credit allocations at the last mile. But I think let's leave some time for questions. I'm sure you want to know more.
Thank you, Viral.
Yeah, yeah.
So we will have a few minutes for questions. We have to go for lunch at 1 o'clock and discuss things over lunch. But I'm sure there's a few remarks now that we can directly put. Jean-Charles, please go ahead.
A clarifying question. How much of the fiscal dominance problem is related to the political structure of India? In other words, how much local governments matter for that? Are they allowed to borrow on their own? What's the...
Yeah, it's a really great question. I think India is a very interesting cooperative federalist structure, as they call it in India, which is that state governments can borrow on their own. These securities are called state development loans, but they are not loans. They are actually now issued in the market and traded in the market. They are held by banks. They are eligible for zero risk weights and liquidity coverage ratio, high quality liquid asset classification. Historically, no state in India has defaulted as of yet on its debt. But there is a legislative agreement between the center and the states, which basically says how much can the state governments borrow as a fiscal deficit each year. There are deviations from that. If you go beyond those statutory set limits, you have to get a permission from the finance ministry. Each state minister has to get a permission from the central finance ministry to issue extra debt. Sometimes they are granted. They are typically granted if the state government is of the same party as the central government. It's a little more difficult permission or delayed permission if it's the opposition or another local party that might be at the state. And for things like value-added tax, which was implemented in India in 2018, there is again a legislative sharing rule. The tax is collected by the center, but then a certain proportion of that goes back to the individual states. Now, what is interesting is that the Indian election, so there are two things which are very kind of interesting at a micro level, which is that unlike United States, India doesn't run its state and national elections at the same time. So in India, an election is happening every day. I'm exaggerating this, of course, but every 6 months there's a state election in India. So it's like a repeated, it's like OLG cycle of elections, So what this means is that horizons are short constantly because the national party is also participating, of course, in the state elections. And now they can use the national mandate that they have in order to influence the local state outcomes. Now, just like in the US and some other countries, there are certain restrictive periods on what you can and cannot do prior to an election, but those apply to the national election. So the central government can do whatever national policy it wants before a state election is coming due. So there are very interesting potential research questions that can also be analyzed on the role of the center in influencing through national policy, local state election outcomes, and so on. Just one last point, Jean-Charles, on what is the role of the central bank in all this. The central bank also places the state debt in the auctions. So it's in charge of controlling yields on both state debt as well as the center debt.
But does it keep this debt in the balance sheet, or is just a placer?
So in the liquidity facilities, so in the overnight repo liquidity facilities, both central and the state debt are eligible. I think they have slightly differing haircuts, but that keeps varying over time. To the best of my knowledge, when they have done quantitative easing, they have primarily purchased central government debt because it's the only liquid market. The state government market is not as liquid to do open market operations and quantitative easing. I think the central government would not be very happy if quantitative easing was done with state government debt. If I can just add one more point to that, which is very interesting, is that most of us think Ben Bernanke invented quantitative easing. Actually, quantitative easing was invented by emerging market central banks long back, like India has been doing quantitative easing since independence in 1947. The central bank is the master of quantitative easing. They do it primarily to facilitate government borrowing, because for a long time, that was the only market in the Indian economy. That was the only credit mechanism in the Indian economy. And it is expected all along at all points of time that if government borrowing costs rise beyond a certain point, the central bank will undertake. They don't call it quantitative easing, but it is quantitative easing.
Reminds me of other central banks these days. Comment.
Well, we have a question from online participants.
Okay, thanks.
Is there a role for the international standard bodies to mitigate the risk of the advanced economy central bank going down the path of the emerging markets central banks?
I think there is, but I'm a bit skeptical in the end, because my sense is post, I don't mean it as a criticism of these bodies, and there were good reasons, I think, during the pandemic to do so. But my sense is a lot of these bodies basically are also sometimes very short-term focused, because when you have a bad shock, you want to do whatever it takes, I think, to get out. And there's no discussion of unintended consequences. I think, to the best of my knowledge, no central bank has put out a document saying how and when they are going to exit from quantitative easing. I think the Fed tries to give a path, but they keep running into a problem. It's not given at the time quantitative easing is undertaken, because that time they are primarily trying to say, we will do this as long as required. That's the only forward guidance that is given. There is no clear path on exit policy. And it just boggles me. How can you do a multi-trillion-dollar intervention in a market and not have unintended consequences? I just don't understand this. I think if you have any sense of how markets work and how you influence prices and how prices then affect incentives, it's just extraordinary to me. So, but at the time these things are done, it seems like they have a very potent tool. They want to use it in very large quantities. So in my view, the only discipline comes from markets, I think, at the end of the day. Like, you get something like the UK episode, and then you realize that you have done so much quantitative easing, and you get an unexpected shock. And in the midst of your quantitative tightening, you have to start doing quantitative easing again. I think these kinds of shocks are the only way, in my view, that the future scale and scope of quantitative easing might get limited, because the current perception in central banking regulators is that this is a tool that fixes recession with a magic bullet, and we have to use it in as big a scope as possible. And I think we have not exited, so we don't know actually what comes out of such large policies over long stretches of time. And I think emerging markets have shown that it leads to great fiscal dominance. I think it's going to be very hard to exit these policies, because once the central bank is owning 30 to 40% of government debt, if they switch that to 20%, that's going to have a material impact on the cost of borrowing. So they are not going to want central banks to shrink the size of these shares of government bonds that they have. So I hope that international bodies can play a role, but I'm somewhat skeptical that they do it at the right points of time, because they are themselves fully loaded with these rescue packages when the things get really, really difficult.
Yeah, a question over there.
Compared to the advanced economies, do you think the problem in the emerging markets is the fiscal dominance, or being not monetary sovereign? Or not being monetary sovereign compared to advanced economies?
Not being monetary stable.
Sovereign.
Independent.
Oh, independence.
Actually, the foreign currency stories.
I see. So actually, it's a very interesting. I'm fully on board with Helene Ray on this, and actually, the only reason why inflation targeting got implemented in India, starting with Governor Rajan's term in 2013 after the taper tantrum, and then it got legislated in 2016. He was sort of practicing through an informal arrangement for 3 years, and then it became a law at that point. The only reason why that movement could succeed is because of the external sector crisis that India had. Because at taper tantrum, India was running close to 10% of GDP fiscal deficit. It was running close to 10% consumer price inflation. It had a severe bad loans problem on its banking system. And so in 3 months, the currency had corrected by over 25%. And, it was India was sort of in the most vulnerable countries at that time. And it was felt that all of this partly had happened besides the regulatory forbearance on the banking system, because a part of keeping the growth rates at 8, 9, 10% was also very excessively accommodative monetary policy during that time. Inflation was allowed to go very high until interest rates were eventually raised, but it was too late. And it was felt that the only way to avoid such an external sector crisis was to have the central bank with some inflation credibility, that if you don't have a credible inflation targeting central bank, there's no way to prevent this from happening all over again. So while I think the monetary independence is not there, I think emerging markets are fully aware that to do this, they have to impose capital controls, as Elaine Ray would say. But even when they do this, even if they impose capital controls, if the central bank doesn't have inflation targeting credibility, then you could still have a very bad external sector outcome for the economy.
And if they don't impose the capital control but have full
I think then they have a serious problem, the way you are seeing in Sri Lanka when it happened. I think the reason, like India imposes very strict capital controls, like barely 5 to 7% of our government bond markets and corporate bond markets are owned by foreigners. India is relatively relaxed on equity investments, and I think it's the right form of flow. It's more long-term, it's more illiquid, whereas bond flows are much more fickle and hot money style, they come out. Indonesia is somewhere sort of between there. They have almost 40% of their bond markets owned by foreign capital. But I think, interestingly, even IMF, which historically was pushing entirely for open capital markets in emerging market countries, has now accepted that capital controls are very important for these countries to actually safeguard this against these fickle hot money flows and their exit.
Okay, I think we have to end this here, unfortunately, but we have time for discussions over lunch. I was told we leave at 1 o'clock, and we are in fact supposed to basically leave now. I was told we can leave everything in this room. The room will be closed. And so we are going downstairs, and someone will take us to the restaurant, wherever that is. Virat, it was great. It's
okay, thank you so much.